Welcome to Talk Tickers. Today we're breaking down Hanmi Financial's impressive third quarter earnings call. They absolutely knocked it out of the park, and we're going to dig into what's driving the numbers and, more importantly, what could be next for the stock. You just heard from CEO Bonnie Lee, who sounded pretty confident about her team's performance. Well, the market clearly agreed with that tone, sending the stock higher after hours. So let's dive into the results that powered all that optimism. So, Hanmi didn't just meet expectations. They delivered a significant earnings beat. We're talking 73 cents per share when Wall Street was looking for something in the mid-60s. That is a huge 49% increase year over year. Just an impressive performance.
So, the big question is, how did they do it? What's going on under the hood that drove this kind of outperformance? Well, we've identified three core drivers in what we're calling the engine room.
First up, powerful margin expansion. Hanmi's net interest margin, or NIM, expanded to 3.22%. Now, what that means is they got better at increasing the yields on their loans while, at the same time, lowering what they pay out on deposits. That is the magic formula for a bank. And that strength in their margins, combined with some really well-managed expenses, drove their pre-provision net revenue up a super robust 16.4% quarter over quarter. This chart right here brilliantly illustrates their growing core profitability. Okay, driver number 2, exceptional loan growth. Production just surged 73% to $571 million. But here's the real story. It was led by a nearly 300% increase in high-value commercial and industrial loans, or C&I. That's not just growth, that's quality growth. And that brings us to the third driver, and this one is a big one: pristine credit quality. In the current environment for regional banks, this is a major differentiator. Non-performing assets fell to just 0.27% of their loans. But what's really interesting here? The story behind the numbers is even better than the number itself.
Get this, instead of recording net charge-offs, which is what you'd normally expect, Hanmi actually had net recoveries. They collected $500,000 on loans that were previously charged off. That signals a really disciplined and proactive approach to managing credit. Okay, so that was a look back at an awesome quarter. Let's shift gears and look at management's playbook. How does this all build into their forward-looking strategy? Management's guidance on the call was crystal clear. They're focused on sustainable loan growth, they're scaling their key commercial portfolios, and this is the big one for shareholders. They are consistently returning capital through share repurchases. And they backed it up with action. They bought back almost 200,000 shares this quarter alone, and signal that these buybacks are going to be a recurring part of their capital strategy. That's a great sign of confidence. And look, this disciplined execution is delivering clear results. Over the past year, Hanmi has just significantly outpaced the broader regional bank sector ETF. You can see it right there. This isn't a fluke, it's a pattern of outperformance. Okay, so let's dive into what we think this all means for the stock going forward. This is what we call the next call. The key question for any investor now is pretty simple. After a quarter this strong and a 22% run-up in the stock, is this momentum sustainable? Where does Hanmi go from here? We believe it absolutely is. Our outlook for the fourth quarter is very positive. We see them staying on track for loan growth, we see their margins getting a nice tailwind from lower funding costs, and those ongoing buybacks should provide a solid floor for the share price. So, putting it all together, here it is. We are initiating with an outperform rating. Hanmi is demonstrating what we see as best-in-class execution, pairing really disciplined credit and expense management with a unique growth engine. And just to be perfectly clear, this is not financial advice.